Hey, hi, this is Kribakaran Rajendran, founder of Algo Trading from squareofbots.com. So, thanks to the bull market, and we have been seeing a lot of videos and a lot of people talking specifically about momentum trading. See, momentum trading has gained more traction, just like how option selling gained more traction in the recent past after COVID. So, we are currently in a very big bull run, and even with respect to mid caps, small caps, every single stocks is rallying big time. So the momentum factor greatly helps during the bull markets. So during the bull markets, all kind of stocks moves up, and these momentum based strategies or these momentum based methodologies specifically identifies these winners and picks up those winners and starts investing and then rebalance it on a weekly basis, monthly basis, or quarterly basis or half-yearly basis based on one's methodology. So the basic idea behind momentum rules is buy higher and sell even more higher. That is the basic concept. So the actual rules of value investing, it's like you buy the stock when it is cheap and sell when it is overvalued. Momentum is totally opposite of that. So we just get into a stock whichever relatively outperforms the specific benchmarks or index. You invest in that and you rebalance it on a periodic basis. That is all momentum is. But there are certain things that we need to keep in mind when you're trading momentum. See, momentum is just like trend following mean reversion. It has been there for a very long period of time. So in 1993, Jagdish and Titman they published a paper stating a detailed research about how buying a stock which has already run up in the past. Like many people will be hesitant to buy a 52-week high stocks, right? Because in the last 1 year that stock has reached a very high price, and many people will be really hesitant to buy that stock because it has already moved up. But statistically, a stock which hits a 52-week high will continue to move up and make new 52-week high. Even it can make new all-time high as well. So people prefer these stocks. So momentum traders specifically prefer these kind of stocks and they invest in it because they wanted to capture that rally. If you're trading a super trend strategy, what you do, you apply that super trend to an index or a stock. Whenever it gives you buy or sell signal, you buy it, right? Now, if you wanted to apply the super trend with respect to 50 different stocks, so in 50 different stocks, you will get some 25 buy signals, 30 buy signals, or even 40 buy signals when the market is in uptrend. But you will not have cash to buy all the 40 stocks, right? So how do I pick only the 5 stocks or 10 stocks from this whole universe of 50 stocks baskets or whole universe of Nifty 500, whatever the universe is? So basic idea is you have this ranking mechanism. You rank the stocks based on certain methodology and pick those top 5 stocks, 10 stocks, or top n number of stocks. That is totally based upon the user's methodology. And they invest in it. And then they don't use any specific stop loss. Like for an example, when a super trend gives you buy, you buy it. When a super trend gives you sell it. But here, instead of using a fixed stop losses, they just rebalance it. They just invest in it. And after 1 month or 6 months, based on the rebalancing period, they totally rerun the same mechanism. Whatever the condition that is satisfied, those stocks will be there. Whatever the condition that is not satisfied, those stocks will be removed from the list. Now the problem is there are so many options for you if you wanted to go for momentum based trading. See, you have small cases where you can invest in any of the small case which is based on momentum, and there are other people who sell these momentum based services. There are screeners out there, there are tools out there which helps you to track these momentum stocks and trade it. But if you wanted to avoid all this and still if you wanted to make those kind of momentum based trading returns, there is one simple method that you can follow, which is just investing in those respective ETFs or index funds which replicates the momentum factor. Okay, under NSE there are multiple strategy indices, just like how we have small cap, mid cap, these are multiple indices, right? So likewise we have strategy indices where NSE itself does all this performance analysis or follow certain methodology and created baskets of strategy indices. So people who wanted to replicate these momentum factors, you have a Nifty 200 momentum index. This aims to track the performance of 30 high momentum stocks across large and mid caps. So it allocates certain momentum score for each stock based on the last 6 months or 12 months price returns adjusted for volatility. The people who wanted to replicate this momentum strategy, specifically this Nifty 200 momentum ETF, there are certain ETFs and there are certain index funds out there where you simply go and buy this, using which you can get the same momentum returns here. So out of this, there are no some 9 different ETFs and index funds which replicates Nifty 200 momentum rules. So out of this, you can go for two things. Like you can go with the one which has the lowest expense ratio, one thing, and you should also choose the one which has highest AAM. So out of all this, Nifty 200, UTI Nifty 200 Momentum Index that has more than 2,400 crores of net assets under management, which replicates this momentum rules with the expense ratio of 0.4. So out of all this, I would prefer this one. Basically, it has a lower expense ratio, and also overall AAM is also comparatively much higher. No, it's more than 10 times higher than rest of all the funds. So this is something that I would highly recommend if you wanted to replicate the momentum rules. If you wanted to get the same momentum returns, you can apply it here. The blue chart that you see is nothing but the Nifty 200 Momentum 30 Index, which is compared with the normal Nifty 200 index. So as you could see, relatively the outperformance has been really great with respect to Nifty 200 momentum rules. So even if we check the overall returns since inception, so this is the overall CAGR returns of Nifty 200 versus Nifty 200 momentum. So the normal Nifty 200 has given only 12.7% CAGR since inception. However, Nifty 200 momentum rules, if we apply on it, it is giving almost 18.6% of overall returns, overall CAGR. The Nifty 200 momentum 30 has given a higher risk to no return to risk ratio versus the normal Nifty 200 index. And also, the Nifty 200 momentum index automatically adapts to the changing market condition and increases or decreases the respective weightage to those respective sectors. So if there is one specific sector that really does well, then the weightage will be increased to that specific sector. Those stocks from those sectors will be added more. So this way, by keep changing, so there will be an instance where no IT sector will be really doing well, and there will be certain times where pharma will be really doing well. So we don't need to do anything. The momentum index by default, it automatically checks which one really does well and accordingly provides more weightage to that. So if it can provide such good returns, so what is the downside here? So every momentum will do really well on bull markets and really do bad on bear market. If you observe the 2008 chart, the performance chart here, the index has gone down almost near 50%. So the overall correction is 50% there. And again in 2020 during corona pandemic, the overall correction is approximately around 30 to 40%. So even the respective index also crashed the same. Like if you compare Nifty 200 index, that also crashed to the same extent of 40 to 50% during 2008, and 2020 that also crashed 40%. So in both the way, the risk is same, but the returns are superior here. So when the market goes down, the index also goes down. Your momentum index will also go down. But when the market goes up, your momentum index returns gives you a much higher returns. So that is the main difference. So that is why they say the risk adjusted returns is much better with respect to the Nifty 200 Momentum 30 index versus a normal Nifty 200 index. I'm showing now UTI Nifty 200 Momentum 30 index. That's a direct plan where you can directly buy through coin or any other mutual fund platform. So as you could see, the overall performance during 2021 with respect to that specific index, the overall the comparative benchmark index has given 20% returns, but this one has given almost 49 or 50% returns during 2021. And again there was a down period, and again there was a up period, and even with respect to the current bull market, as you could see, the returns are really much better than the overall the respective benchmark index. So if you're a fan of momentum, and if you really wanted to trade with a diversified set of portfolio which includes both large cap and mid caps, that constitutes of top Nifty 200 stocks, then instead of applying the momentum rules with the basket of BSE 200 or Nifty 200, you can go and directly buy this specific index funds which replicates the strategy index of Nifty 200 momentum 30. So this way you are able to control the cost to a greater extent, and also the execution becomes much easier. All you have to do is just go and do a lump sum investment in that specific index fund, and that will do the rebalancing and everything for you automatically. So there is no necessity for you to monitor or focus on executions or focus on any kind of third party platforms. So this way you can get to invest in momentum, ride the bull market using the momentum strategies without much complications at all. So this is what I wanted to convey in this video. So hope you found it really helpful. I'll see you guys next week with another topic. Bye.